podcast. It is Thursday, March the 6th. Great to have Ole Hansen with us, Head of Commodity Strategy at Saxo Bank, Yuri Humber, Founder and President of Japan NRG Platform and the Yuri Group, and Dimitri Zebelen, Founder of Pantheon Insights. Thanks, gentlemen, for joining us this morning. Ole, let me go to you first, and let's get your take on this tizzy that Trump is throwing commodities markets, oil markets, trade partners, not knowing which way, how to react. I mean, I think there's a bit of predictability now that he's saying what he said he's going to do. The other predictable part is that he's going to retract all the time, isn't he? And keep going back and forth. But how are commodities markets meant to deal with this? And how are they reacting so far?
Well, good morning, everyone. Well, the market is most certainly reacting with a great deal of stress, I would say, and I think not only market traders right now, everyone is somewhat on the edge simply because we don't know we're moving from one headline to the next.
Yeah.
In the commodity market, we're seeing obviously several things unfold for a few months now, or for at least a couple of months. We've seen some dislocations in the New York futures market simply because the worry about having to pay tariffs on some of the commodities that are traded there. That's particularly impacting the metal market. We're seeing the oil markets now drifting lower on worries that a global trade war could lower demand. We're seeing grain price in the U.S. Suffering on worries about lower demand from Mexico and Canada. And we can continue. So all of these markets are really in some way, shape, or form being impacted. And on top of that, we obviously do have something like gold, which just continues to shine and continue to move higher in anticipation of, or basically a simpler reflection of this world is right now not a happy place to so to speak. Investors are looking for protection. The exceptionalism in the U.S. stock market seems to be fading very fast. And we now have other regions where stock markets are making stronger progress.
Yeah, I mean, like China, for example, has had a bit of a recovery. Maybe that's unrelated to all the trade uncertainty. Thanks, Ole, for that. Dimitri, welcome, and good, very early morning to you, probably. Thanks for joining us. I mean, let me go to your company. Tries to advise businesses on what to do based on your geopolitical interpretation of what's going to happen, etc., and risk factors out there. How can you know what to advise these days with what's happening? Or is Trump perhaps more predictable than others, and so people can sort of, I suppose, put up barriers and protect against that? I mean, how has that changed your insights, if you like, into how to advise?
Absolutely. Well, first off, thank you for having me. It's great to be on with all these other great panelists. And yeah, what's really interesting is that I actually am quite surprised by how erratic Mr. Trump is. And I know people may find that laughable, but I mean, relative to how his first term was during his first administration, we're actually seeing a lot more what you might call policy whiplash now relative to before. First, we had the threat of tariffs against Canada and Mexico, 25%, 10% against China. Then there was a 30-day extension, rather a 30-day delay. And now we're at the end of that delay, and those tariffs are going to be implemented. But then we heard Lutnick make an announcement that some of those tariffs may be rescinded. But now it looks like they may not be rescinded, but instead we're going to get certain exemptions from agriculture products. And predictably, in my view, what they're going to start targeting, the reason why they exempted agriculture products is because the last time this happened during his first administration, and I warned about this as an FX analyst at my former employer, is what I said is, look, they're going to shift operations to Brazil. And surely enough, they did. Soybean futures contracts based in Brazil, of course, skyrocketed because they're the next biggest producer. And that also complemented a lot of China's other strategy when it came to Latin America, to the extent that they're the region's largest external trading partner, which for the US is quite a bit of a geopolitical embarrassment, to the extent that it's right in their backyard and they're not the biggest trading partner. That's not even looking at the soft rhetoric about trying to create a South American common currency like the euro. There was some babble about that a couple of 2 years ago, and I call it babble because it can't be implemented, and the eurozone itself is struggling with its own problems when it comes to that kind of currency union. So as far as geopolitical risk advisement goes, sort of what I've been telling my clients when I've been publishing a lot is supply chains are being increasingly politicized, And what I mean by that is that a security first paradigm is dictating economic policy more so than what is effective and cost efficient, right? So you can look at that as China as the prime example. Why de-risk from China? You could argue its labor cost per unit is rising. Certainly Indonesia and Mexico are serving as alternatives at the lower end of manufacturing and low-skilled products and labor, but it's quite expensive to de-risk, or I mean, it's just a euphemism for decoupling. So what I tell clients is look at where the geopolitical fault lines are. Where are your companies operating? And then from there, determine what your supply chains will be. Because you can see within target industrial policy, like the Inflation Reduction Act, Biden said, or rather the provisions in the Inflation Reduction Act said, you can get these tax credits for your EVs, for instance, if your supply chains do not touch at any point on any of them China. And so that's a targeted industrial policy, part of what's called ABC. Anything but China. So to answer your question in one sentence, what I advise clients is look at where your supply chain's policies are, look at the market that you're targeting, and see where along the geopolitical fault line you fall, and that'll then determine it, because that'll then determine whether or not you may be subject to export controls or potentially secondary sanctions, etc.
Yeah, I mean, it's certainly, as I said, whiplash, many moving parts, and even if you do that and assess where you are today. Next week, Trump might change the goalpost, wants to move the goalpost. And so very hard, I suppose, for countries and companies to strategize. Presumably, it'll all calm down at some point. Yuri, I mean, as a major sort of energy consumer and importer in Japan, how do you think Japan is looking at this in terms of the impact, obviously, on prices? And also, I mean, a couple of headlines today, Trump again telling people what to do, bossing countries around saying you must buy this and you must invest in that. One of them is South Korea, Japan to partner with the US on an Alaskan pipeline. Is Japan getting nervous given that it is obviously reliant on energy imports and has its own economic issues, hasn't it, for quite a few years, and it's just kind of emerging from that?
Yeah, thanks very much for having me on again, Dela, and thank you for the question. I'd have to agree, a lot with Dimitri and then what Ollie mentioned earlier. One, you have extremely volatile markets. Two, you have quickly changing supply chain risks with clear geopolitical premiums. And in that environment, to be asked to invest in what is, undoubtedly a decade-long project, that has been touted as maybe $44 billion, but inevitably is going to be a lot more than that, is quite a big ask. I think that, there are a lot of things that don't really make sense in these discussions. And I'll just throw out some really basic numbers. I mean, for one, Japan's LNG consumption has been on a downward trend for the best part of the last, decade. There are some factors that would see it potentially increase, and I think there's certainly room for there is a case for why consumption could go up, but certainly not to the extent where you'd want to completely change your energy security outlook, which is to say that you massively diversify your portfolio and put all your eggs in one basket, and therefore sort of put it all into one mega project in anywhere, never mind sort of an entirely new greenfield domain. I think the other, say, from South Korea's side, look, it's only maybe a week or so ago that we heard that South Korea has set a new target that would essentially see its gas-fired generation go from closer to like 30% of the total to something as low as 10% by 2040. So in that kind of fundamentals trend, I'm not really sure where the appetite is from these countries to go in and invest massively. I mean, one news item that came out just earlier today is Mitsubishi, which would be certainly most likely one of the prime candidates, actual companies that would be asked to sort of come in and be involved in the Alaska LNG project. They've also invested in LNG Canada, which is the first Canadian LNG project that's about to start delivery from the middle of this year. And so earlier today saw one of the Mitsubishi Corporation executives say, well, actually, this is just the beginning. This is phase one. We'd actually like to expand it to phase two and so on, because it's cost effective to expand projects, as we all know. So the question is then, if you're investing quite a lot in Canadian LNG supply, what would be the sort of the economic rationale? There may be some rationale, but would there be enough rationale to justify such a gigantic project as is being proposed in Alaska? So if it's not all about economics and it is a lot about politics, then who should pay? Certainly, Japan isn't China. The government cannot order the companies just to go in and make those investments. So are we going to see a very large amount of government spending coming into these mega projects? And if so, how is it going to be justified? And how do you justify it on the basis of such consistent volatility in policy?
Absolutely.
And so forth?
Yeah, I mean, again, forcing companies to invest. I mean, look at what Trump did the other day. He made 2 companies invest in a segment of the Panama Canal, one of the ports there. Essentially, obviously on the other side of that is some threat of some sort, isn't it? And it's one thing what he can do in America and perhaps others. And then you had an announcement overnight from Taiwan saying it's going to invest tens of billions in Arizona in tech through its company TSMH, the chips. So there's a lot going on, obviously, but clearly Trump is playing a lot of cards in one go. Ole, let's go back to the oil markets and just talk a bit about the bearish sentiment there, because again, that hasn't shifted, has it? And it's got much, prices have dropped $2 or $3 in the last week or 10 days. And yet OPEC came out and said it's going to plan to still increase volumes incrementally from April. It said that because it needed to make a statement, but realistically speaking, do you think it can really, even as those amounts are incremental, that's surely a silly policy at the moment, and the market was not expecting it?
Well, the market was no, probably not expecting it, but I think at the same time, I don't think the impact is going to be as big as perhaps some are fearing. We're looking at 2.2 million barrels over quite an extended period. We're looking at the same time at Venezuela and Iran that has increased production in the last 4 years by around combined 1.6 million barrels. I think we could potentially actually in the short term see sanctions against these mean that that production will slow faster than the increase will from the other producers. I think we're just going to see a change of market share within OPEC in the coming months. So they continue to postpone it, but I think also part of the fact is simply the realization that we are not going to go back to $90 anytime soon. So in that case, what has been the main problem for the last 2 years? Basically, that high prices has allowed a lot of non-OPEC production growth, and by sending prices to these levels, we will probably see that start to slow fairly soon. We're into the mid-60s now in WTI, looking, as also mentioned, you have to look a bit further out to see if you want to really make big investments, and WTI a few years out is trading even lower, making the appetite for big projects to increase US production much reduced. So I think this is probably the first step towards a OPEC regaining some of the market shares that they've been losing in the last couple of years. So there's a natural flow under the market. We've been calling 65, 85 since December last year. I haven't changed that yet. I think if we do break below 65, and that is in Brent, that will speeden up the normalization in the market.
Yeah, absolutely. As I said, non-OPEC producers like the US will certainly, or who are already hesitating when TI was still holding at around $70. Thanks for that, Ole. Dimitri, Ole mentioned that Iran, Venezuela sanctions might be toughening up. That'll take some oil off the market, help OPEC in a way. But the other member of OPEC Plus is Russia, and again, a lot of obviously dynamics going on there in terms of what the US is engaging Russia on, clearly on the Ukraine question. Give us your take on whether you think we're going to see a ceasefire and peace deal there emerge in the second quarter. Are those the indications you think are going to materialize? And what impact do you think it'll have on Russian oil, for example, if at all?
That's a great question. Unfortunately, I don't have a direct answer for that because, again, like with Trump's trade tariffs, we're seeing now how with the mineral deal, we're seeing a lot of volatility there. When it comes to his tactics, we are seeing certainly him employ a very tough negotiation stance, which is his modus operandi. It looks like the mineral deal, personally, I do see a peace deal as inevitable. I'm not sure about if the second quarter is when it'll happen. But in terms of oil prices, my take on it, because you mentioned sanctions earlier, and secondary sanctions, there was also discussions about targeting Chinese and Indian firms that were importing oil from Iran as a way to stranglehold the IRGC, which really are the economic element that control all of it. My take on it is that crude oil prices, even with those geopolitically induced supply disruptions, my take on it is that crude oil prices still have a very bearish outlook for the year. And that's something I've maintained on the show even towards the end of last year, to the extent that even though Trump's drill baby drill is not very straightforward because it'll take some time to get some of these other operations online, it's not like they can just flip a switch. In addition to that, trade wars can weigh on growth. I mean, we saw how international trade, I think it was in 2017, was at a growth of 8%, and by 2019 it was down to 0.4. That definitely had a negative effect on crude oil prices. You saw OPEC tried to implement cuts, and even then oil prices still began to fall. OPEC also announced that they're going to start unwinding, I think it's 138,000 barrels per day starting April, as part of their plan to unwind 2.2 million BPD voluntary cuts, and that's going to stay until September of 2026, if memory serves. So if you have, in essence, then growth hampering effects of a trade war, and the European Union looks like they're coming to play because they developed even a new specific policy framework to deal with economic coercion vis-a-vis tariffs, which shows that if you're creating a framework for it, a formal one, it means you are essentially really getting ready to go to economic war, as China's embassy recently put it, even though I'm referring to the European Union here. So if you have weaker growth, and you have something like crude oil, which is a very cyclically sensitive commodity, and you have the prospect of higher inflation, which could then lead to the Fed to not just pause interest rate cuts, but to potentially even hike them, that's also a growth hampering effect. I think those are just two factors there. You are seeing weaker economic growth in the US. GDP for Q1 was revised lower. I think it's now minus 2.6%. You're seeing persistent weakness in the white-collar job market that's having spillover effects. People are dipping into their 401ks at 4.6%. That's the highest level on record. So we're seeing a lot of then weak consumption out of a consumption-based economy, which would also weigh on oil. In my view, there's a lot of forces pressuring oil prices lower, and while geopolitical induced supply disruptions, fears, perceived or real, may cause short-term volatility, fundamentally, in my view, the forces are bearish against oil.
Yeah, and against,
I mean,
US growth, as you said, I mean, finally we're seeing the US economy come under some pressure. Last year was expected and it never happened, and we kept seeing everything go up and up, including the stock market. Ole was mentioning that's finally taking a turn, a lot of nervousness around. And of course, Europe, and we'll go to Ole on that later again. If US economy is not doing well, the European economy has been suffering even more. Yuri, let's go back to you though and talk about the Japanese economy, because it has had its own struggles. Give us an outlook, on how the yen is doing, what the policies might be to be influencing that in terms of its trade policy as well. And another headline here mentioning how Japanese 10-year bond yields have jumped. Again, the inflationary outlook, currency outlook for Japan, given its trade position, if you like.
Well, Japan has spent about 25 years waiting for inflation and wishing inflation, but it's finally got it a little bit more than it bargained for, and is certainly not used to it. If a country's not used, if companies and businesses, and most importantly households, are not used to inflation, then suddenly seeing this inflation rise close to double digit in groceries, and certainly double digits in energy, that has a massive impact. And that has translated into some of the political instability that we have seen, again, unusually in Japan, because we have, for the first time in a very long time, we have a minority government in Japan. And Prime Minister Ishiba's position is somewhat, is quite a lot weaker than that of his predecessors. So what does that mean in terms of the Bank of Japan has hinted at another interest rate raise, potentially going up to levels again we haven't seen for about 16 years. And that is interesting, because during the previous if you like, the previous cycle under the Biden administration, you had the Bank of Japan in a counter-cyclical move where you would have a constantly either negative or zero to negative interest rates in Japan, and rising interest rates in the US and Europe. So that would then pressure the yen to be weaker, And hence we've seen the currency sort of roll back from about 110, 120 to the US dollar level to 150, and even almost touching to close to 160 in the last year. Now that the Bank of Japan is actually potentially moving in the same direction as the Fed, and as Dmitry said, if the Fed now goes in the interest rate rising cycle, then some of the pressures from the yen will ease up. However, given the trade and the tariff uncertainty, I think there is no clear direction that the FX market knows which to take at this moment. So some of the older narratives no longer work. That's why you've seen sort of the yen go down to break the 150 ceiling, get into the late 140s level, but has now actually gone back up to 150 something. And I think there is no clear outlook, or there's no market consensus about which way it should definitely go from now on. Economically, Japan has been again in an upcycle, benefiting from some of the delayed recovery post-COVID and so forth, and government spending. However, now, again, with the uncertainty around tariffs, but certainly with tariffs against autos, the economy could certainly slow down quite heavily and very suddenly. So I think that there's basically, unfortunately, really isn't a good answer at this moment.
Yeah, a lot of uncertainty. Ole, let's talk a bit about Europe, the ECB. We've been talking about interest rates and Fed and what it might or might not do next. Let's just quickly look at that survey question. If oil prices drop, as they have with TI, and if they hold below that $70 for most of March, if we continue to see that weakness, OPEC Plus will have no choice but to reinstate its production cuts in the next 3-4 weeks and kind of reverse what it said. Agree or disagree, I suppose it depends how far, that does fall. Ole, let's talk about the European economy as well, because it's clearly having a hard time. And now you've got the added pressure of the political, dilemma that Europe is facing in its negotiations with the US on behalf of Ukraine and on behalf of its own continent, ultimately. Macron headline saying that, Europe is at a turning point in history, and if we're gonna manage without the US if we have to, but we'd prefer to have them on board. What is the economic mood in Europe today, where you sit in the context of these sort of trade, tariff tit for tat, and also, obviously the most recent skirmish between the US and Ukraine, and what Trump said in his speech the other night as well?
Well, obviously, first of all, just noting the massive difference in opinion around the world towards what's happening right now. I just spent some time in the US, and it's obviously very clear how we have an extremely divided country. If you look at Europe, I think the initial thought to the event in the last couple of weeks is actually one of really a great deal of optimism. I think this MAGA maniac is going to actually lead to make Europe great again. We've finally seen Germany waking up. They slashed their limitations on borrowing, and it really was what's been holding back Europe. Obviously, we see Euro's exceptionalism has been driven by a rate on the fiscal coffers by issuing debt. We're going to see some of that now, but actually Germany can afford it, and we're going to see a massive boom in spending, obviously towards defense, but also infrastructure. And so I think we're potentially seeing a revival, and also just simply Europe waking up and realizing that we cannot just depend on the US, especially when it's become such a volatile place for governing as it has been. So I'm actually very optimistic. It will take some time, but I think we've seen the first signs of something that could potentially become very beneficial for Europe. And at least the first initial reaction has been a very big jump in the stock market, but at the same time also we've seen the biggest jump in German bond yields that I've seen in my time since the German wall came down many years ago. So we're going through obviously a bit of stress as well, because with the whole the whole situation with Ukraine, we'll see where that lands. But generally, I would say we are starting to see some emerging signs of optimism.
a new beginning, an optimism, but along with more debt, it sounds like, you know, going down the US, you know, multi-trillion-dollar debt route, perhaps, if that's what it takes, Dimitri. I mean, let's talk a bit about that and the debt, you know, question in the US. Trump, one of his main policies, sort of what's backed his policies, he says, is that he's trying to obviously cut their overseas expenditure, deal with this debt situation, but at the same time, obviously, cut taxes, and that's why he's doing it. I mean, again, how seriously do you think investors are taking the extrapolated debt situation in the US, and do they take Trump seriously in terms of, you know, him being able to slash that, you know, foreign expenditure over time?
Yeah, sure. So a couple of points. Ole, to your point earlier, I mean, the fact that Germany is not considering, but is going to loosen up their debt structure. I think that's something that's wildly underappreciated. I mean, that's huge. A lot of Eurozone conflict has come from how the difference in debt management between Germany and really the south of Europe, Greece, Italy, Spain, you name it. So the fact that that's not being reported on as much, I find suspicious. And yeah, bond yields are surging through the roof. I imagine CDS spreads are widening as well, because if they're known as the steward of frugality when it comes to government expenditure, and they're looking to loosen that, that says something. As for government expenditure and debt in the U.S., it is a problem you hear about frequently. I think, what is it? Debt interest payments are like $1 trillion every 3 months. It's some crazy statistic like that. My view on it is that investors aren't taking it really that seriously, to the extent that, one, it's a long run problem. And two, if the concern is, let's say, a massive dump of US dollars, that's not really going to happen, because the dollar it's the world's reserve currency. Every central bank has dollars on their balance sheet. Most commodities are priced in dollars. All capital funding and raising is done in dollars. So to the extent that a long-term debt problem would erode faith in the dollar, that is a long-term problem that doesn't really have an investable or tradable timeline. And it's such a volatile thing to try to incorporate into a risk model that it'd be pretty difficult to sell to shareholders, anybody else who are trying to devise an investment strategy around. So while it is obviously a concern, and Trump's looking to diminish some of the foreign expenditures, of which defense, I don't think, is going to be one of them that's cut. We saw a false flag there that Peter Hegseth later said it's not taking $50 billion away from the budget, it's redirecting it, which again is not the same thing. So in short, no, I don't think it's a legitimate long-term, I don't think it's a legitimate short-term concern that investors and traders are looking at, because there's no tradable time horizon for it.
Okay. One development on US debt has been that China has been releasing a bit of what debt it holds, hasn't it, in terms of the treasuries. And again, so part of their trade back and forth with the US negotiations, I assume. Yuri, let's go to close for us today, and just give us an update on how the nuclear program is going in Japan, because there have been attempts to, obviously, you know, since Fukushima, which was a long time ago, to sort of reinvigorate that. There were a couple of issues domestically on certain plants that were going to be reopened. What's the update on that? When we last spoke, you said that was making relatively good progress.
Well, it was, but unfortunately, we've run into some more difficulties at this moment. So actually, one of the major nuclear power plant that's closer to the Tokyo area has now been thrown into more uncertainty, because yet more upgrades are requested, yet more complicated negotiations, local stakeholders are requested. So in this sense, I think the outlook over the next 2 years for the nuclear program in Japan is that we keep steady with the amount of reactors already restarted, but new restarts are looking a little bit less likely, at least over the short term.
Okay, thanks for that, Yuri. Ole, okay, there's our answer for today. If oil prices drop, that's pretty close. Agree, 58%. I mean, that certainly is what the market was saying up to the point when OPEC said otherwise. And I suppose it's a moving target, isn't it? And they can adjust as and when they want to. Ole, just to go to you very quickly on that question of, I mean, I know you're on the commodity markets, but in terms of China, we haven't really mentioned that in detail today, but again, in the context of its its trade responses to the US so far, what it's done in terms of cutting energy imports into China, in terms of what it could do with rare earth minerals, etc. Where do you think it could use that tool going forward on the commodity front in its trade negotiations with the US?
Well, it's a massive bargaining tool, and you can see, well, that's why Trump is scouring the world for countries to take over.
As he said, raw earth. He kept saying raw earth, and in his press conference, and he should have said rare earth.
Yeah, he hasn't got a clue what he's talking about.
He hasn't even got the word right. Yeah.
No, but so it clearly indicates that that China's got the upper hand on this front, simply because they are the biggest refiner. They're not the biggest miner. It's found all around the world. So rare earths are not rare, but they're rare. They're made rare because the processing of producing them is very difficult, and that's really one China has taken over for decades because no one else wanted to touch it.
Yeah.
Companies elsewhere has closed down. So it is a massive, major tool that they hold, because it's small in size in terms of nominal value, but in terms of importance, it's massive.
Exactly. And I mean, it's one thing for now the West start playing catch up, but it's going to take years to mine that, isn't it? And China can just switch off that lithium to those who need them for their batteries if it needs to. So yeah, a lot of games being played. Thanks so much to Ole and Yuri and Dimitri for joining us today, and have a great week ahead, remainder of the week and weekend. Thanks so much for joining us, everyone.
Thank you.
Thanks.
Thank you.